Welcome back to Smart Money Made. Today, under our Money Basics series, we're breaking down something that affects almost every financial decision you'll ever make: your credit score. You've probably heard the number matters, but do you really know how it's calculated and why it matters so much? By the end of this video, you'll understand exactly how credit scores really work. A credit score is basically a three-digit number that represents how risky or trustworthy you look to lenders. Think of it as your financial reputation. In the UK, scores usually range from about 300 to 850, depending on the credit agency. The higher the number, the more confident lenders are that you'll pay back what you borrow. That confidence translates into better loan approvals, lower interest rates, and even cheaper insurance in some cases. Now, here's the part most people don't fully understand. What actually makes up your score? There are 5 main ingredients. 1. Payment history, about 35%. This is the single biggest factor. Do you pay your bills on time? Even one missed payment can drag your score down for years. 2. Credit utilization, about 30%. This looks at how much of your available credit you're using. If you've got a $5,000 limit and you're constantly maxed out at $4,500, lenders see that as risky. Ideally, you want to keep usage under 30%. 3. Length of credit history, about 15%. The longer you've had accounts open, the better. It shows stability. Closing old accounts can sometimes hurt you here. 4. Credit mix, about 10%. Lenders like to see that you can handle different types of credit, like a credit card, a car loan, maybe a mortgage. It shows versatility. 5. New credit, about 10%. Every time you apply for credit, it leaves a mark called a hard inquiry. Too many in a short time makes you look desperate for money, which lowers your score. Let's clear up a few myths. Checking your own credit score does not hurt it. That's called a soft inquiry. Carrying a balance on your credit card doesn't help your score. In fact, paying in full is better. And no, you don't need to be in debt to have a good score. You just need to use credit responsibly. Why should you care? Because your credit score can literally save or cost you thousands of pounds. A strong score means lower interest rates on mortgages, car loans, and credit cards. Over a lifetime, that difference can add up to tens of thousands in savings. It can even affect renting a flat or getting a mobile phone contract. So that's how credit scores really work. It's not magic, it's math. And it's within your control. Pay on time, keep your balances low, and be mindful of new applications. If you found this breakdown helpful, hit subscribe to Smart Money Made for more money basics explained simply and clearly. Thanks for watching.